There's a financial time bomb that has been ticking for over a decade, quietly powering one of the most powerful industries on Wall Street. And right now in 2025, the fuse has been lit, and the private equity world is following a predictable path to a potential meltdown. For 15 years, private equity ran on a simple, intoxicating formula. Borrow mountains of money at near-zero interest rates, buy companies, and get rich. That era is over. The cheap debt that fueled a multi-trillion-dollar boom has vanished, and the bill is finally coming due. We are witnessing a slow-motion implosion, stage by stage, deal by deal, almost like the industry is reading from a script that always ends in a crash. And here's what should concern you. The first dominoes are already falling, and the real reckoning is scheduled for the next 24 months. This is the story of how the private equity bubble was inflated, why everyone thought the party would last forever, and why the math says a painful correction is next. And it's happening faster than the titans of finance want to admit. The entire private equity model, from the mega deals of KKR and Blackstone to the smaller mid-market buyouts, was built on a foundation of cheap debt. For more than a decade following the 2008 financial crisis, central banks kept interest rates pinned to the floor. This was rocket fuel for private equity. It allowed firms to borrow aggressively, using what's called a leveraged buyout, LBO, to acquire companies with only a sliver of their own money. The strategy was simple. Buy a company, load it with debt, use its own cash flow to pay the interest, and hope to sell it a few years later for a huge profit. But now, with interest rates soaring at the fastest pace in 40 years, that entire playbook is being thrown out the window. The era of free money is ending, and it's ending fast. This surge in interest rates has created a catastrophic problem for the industry: refinancing. The loans used for those buyouts from a few years ago are now coming up for renewal, but the cost to roll them over has exploded. A loan that might have had a 3% interest rate in 2020 could now face a refinancing rate of 8%, 9%, or even higher. For companies already weighed down by debt, this is a death sentence. Their cash flows, which were barely enough to cover the old, lower interest payments, are now completely overwhelmed by the new, higher costs. The math simply doesn't work anymore. As a result, many of these PE-backed companies are turning into zombie firms. Businesses that can generate just enough cash to pay the interest on their loans, but have no hope of ever paying down the principal. They are the walking dead of the corporate world, kept alive only by the hope that rates will magically fall again before they default. This isn't a small, isolated issue. We're talking about a staggering $3 trillion corporate debt wall. This is the mountain of leveraged loans and high-yield junk bonds, many of which were issued to fund private equity buyouts that are set to mature in 2025 and 2026. Imagine a tidal wave of debt that is about to crash onto a shore that's no longer there. Companies that need to refinance will be forced to do so at punishingly high rates, assuming they can even find willing lenders. Default risks are climbing rapidly across the board. The fundamental promise of the LBO model was that a company's earnings would grow faster than its debt costs. Today, the exact opposite is happening. Borrowing costs are rising far faster than cash flows, squeezing companies from both sides and pushing them toward the edge of insolvency. Naturally, the people who lend the money are getting scared. Credit markets are tightening their purse strings, especially for private equity borrowers. Lenders and investors who were once eager to finance risky buyouts are now demanding much higher returns for the risk, or they are simply refusing to lend at all. This credit crunch chokes off the lifeblood of the private equity industry. It's not just that they can't refinance old deals. They can't even get the financing needed to make new ones. At the same time, the traditional escape hatch for private equity firms, the initial public offering, IPO market, has been slammed shut. In a bull market, PE firms could easily offload their portfolio companies onto the public markets for a big payday. But with market volatility high and investor appetite for new stocks low, that exit is gone. They are trapped, holding onto assets they can't sell and can't afford to keep. This high-rate environment has turned private equity's greatest strength into its greatest weakness. The classic strategy: buy a company, lever it up with debt, aggressively cut costs, and sell it for a higher price, is backfiring spectacularly. The leverage that amplified returns on the way up is now amplifying losses on the way down. The cost-cutting measures, which often involved layoffs and reduced investment, have left many of these companies weaker and less resilient, making them even more vulnerable to an economic downturn. The financial engineering that looked so brilliant in a zero-interest rate world now looks reckless and unsustainable. The game has changed, but many firms are still trying to play by the old rules, and they're losing badly. The fallout is beginning to hit the biggest players in the financial world. Institutional investors like pension funds, university endowments, and sovereign wealth funds poured hundreds of billions of dollars into private equity over the past decade, chasing high returns. They are now dangerously overexposed to an asset class that is facing its first real test in a generation. These institutions are starting to rethink their allocations, realizing that the risks they took on might have been far greater than they understood. This is compounded by the valuation illusion. Many private equity portfolios are still being carried on the books at unrealistically high values from the peak of the market in 2021. Unlike public stocks, which are priced every second, private assets are valued infrequently and subjectively by the PE firms themselves. There's a growing fear that these marks are pure fantasy and that a massive write-down is inevitable, which would deliver a painful shock to the institutions that own them. This creates a liquidity crisis for the investors, known as limited partners or LPs. For years, they enjoyed a steady stream of cash as PE firms sold companies and distributed the profits. Now, those distributions have slowed to a trickle because the exits have dried up. LPs are getting frustrated. They have commitments to put more money into new funds, but they aren't getting cash back from the old ones. This is forcing them to look for desperate measures. The secondary market for private equity stakes is booming as a result. This is where investors sell their holdings in PE funds to other buyers at a steep discount, sometimes 20%, 30%, or even more below the stated value. It's a clear signal that sophisticated investors believe the official valuations are inflated and are willing to take a significant loss just to get their cash out now, before things get worse. The banks that financed this whole boom are also caught in the crossfire. During the frenzy, they underwrote massive leveraged loans to fund the biggest buyouts, planning to sell them off to investors. But when the market turned, they got stuck holding billions in risky debt on their own balance sheets, debt they can't easily sell without taking huge losses. This hung debt ties up their capital and exposes them directly to the risk of corporate defaults. Meanwhile, a new class of investors is circling. Distressed debt funds and restructuring firms, often called vulture investors, are raising massive war chests. They see a once-in-a-generation opportunity emerging from the wreckage. They are gearing up to buy the debt of struggling companies for pennies on the dollar and take control of the assets when the defaults begin to cascade. Their excitement is the clearest sign of the pain to come for everyone else. As the risks mount, regulators are finally starting to wake up. They are beginning to scrutinize the systemic risk posed by the private equity industry, particularly its role in loading up companies in critical sectors like healthcare, housing, and energy, with unsustainable levels of debt. The fear is that a wave of bankruptcies in PE-owned companies won't just be a Wall Street problem. The potential ripple effects are enormous. Mass layoffs as zombie companies finally collapse, supply chain disruptions as key suppliers go under, and a dangerous contagion that could spread through the interconnected credit markets, creating a feedback loop that destabilizes the broader financial system. All signs point to 2025 as the year of the great shakeout. It will be the year that separates the disciplined, operationally focused private equity firms from the over-leveraged, overhyped financial engineers who were simply riding the wave of cheap money. We will see which firms actually created value and which ones were just playing a game of financial arbitrage. In response, some of the smarter firms are already pivoting. They are shifting away from the traditional LBO model and moving into private credit, becoming the lenders themselves, infrastructure, and other strategies that rely less on extreme leverage and more on long-term, stable cash flows. They are preparing for a new world where debt is expensive and financial wizardry is no longer enough. So what can investors, workers, and the markets expect if this private equity bubble truly bursts? We can expect a painful period of deleveraging, corporate bankruptcies, and significant losses for the pension funds and endowments that bet big on this asset class. For workers at PE-owned companies, it could mean more job insecurity and restructuring. For the market, it represents the end of a major growth engine and a fundamental repricing of risk across the entire economy. This leads to the ultimate question. Is this just a temporary, cyclical correction? Or are we witnessing the beginning of the end for the private equity boom as we've known it? The forces at play, stubborn inflation, high interest rates, and a mountain of maturing debt, suggest this is not a short-term storm, but a fundamental climate change for the world of finance. The model is broken, the reckoning is here, and the aftershocks will be felt for years to come.